when we think about the oil market, need to distinguish between two effects. One is just higher prices because we bid in a potential premium about what might happen, i.e. risk scenarios, and genuine shortages. What we have seen is just the former, and it lasted for such a short period, actually less than 2 weeks. I hazard a guess, actually, this is not going to show up in a major way in macroeconomic data.
And so when you think about the latest moves, and that is the expectation that we could have a ceasefire in effect, at least that was the message from Donald Trump, I'm wondering how you're digesting this news in terms of what they mean for the global economy.
That's a great question. And look, I think I should just emphasize here the point you made right at the start that it's still delicate. Everyone's watching the news for the next few hours. But if we just work on the assumption that this ceasefire holds, I think there are three implications. The first is we've taken off the table the potential for a global energy supply shock. These are really serious problems if and when they happen. We, of course, were worried about this Strait of Hormuz shutdown. If that's off the table, we take a huge risk off the table for the global economy. That's good news, point one. Point two, for central banks, which would have been looking at this potentially inflationary yet weak growth shock in an uneasy way, they now have the door open to keep cutting. I think we're likely to see a couple of cuts from the Fed and the Bank of England before year end, maybe one from the ECB. That's still on the table. But then third, to what extent actually do we now start to conclude that the administration in Washington has actually improved its credibility a little bit, improved its reputation, having probably disappointed markets with its approach to trade policy in the first half of the year. Together, these three things actually could be a powerful drive for risk over the next few weeks and months.
So it's on monetary policy that I would like to focus for a moment, Kallum, because when we first witnessed the start of the inflation crisis, it was related to energy factors. So given this instability in the Middle East in recent times, and of course, as you also highlighted, the situation is still volatile, I'm wondering what does this mean for the Fed when some officials are suggesting that we could see a cut later in July? Do you think that is likely?
I think July is probably a bit too soon. I think what we're seeing is marginal signals about the direction that the Fed is likely to head. I think if the Fed has some courage, it could certainly go in July, but I think most likely the next cut's going to come in September. Now, the question for the Fed is, to what extent can we now start to dismiss inflation risks and start to focus on what looks likely to be a modest deceleration in economic momentum this year? And I think we should just bear in mind what the essential problem is for the Fed. The Fed has a dual mandate. It has maximum employment, but it also has price stability. The tariffs have put the Fed on a collision course here between the two sides of its mandate. And so it's really a question of which can it focus on? If it can start to say, well, actually, we have a handle on how much inflation is coming through, it's going to be a bit, but it's not going to be a huge amount. But now we can start thinking about employment and GDP, then we can move towards rate cuts. And the problem that the Fed had over the last few months is it couldn't really see which way things were breaking. Of course, the potential for an oil price spike drew focus again to the inflation side of the mandate. But it seems to be clear now that actually we're going to get weak growth, a bit of inflation, but probably not so much that the Fed can't look through it. And so I think we're setting up now for a September cut, so long as we don't get big inflation surprises over the next few months.